Hey guys, it's JP Invest, and today we're going to be talking about options and how to use a strategy called the wheel strategy to maximize your profits with shares that you own and capital that you are holding in your portfolio. To start looking at the portfolio, we're up 6.1%. The portfolio the brokerage that we're using is Robinhood, which is really seamless for these options, and it is super helpful for learning and beginners. So if you guys want to sign up, I do have a code that will be down in the description. If you guys just click that link, you guys will get 2 free shares for signing up and depositing some money into your account and just getting started investing. You know, it's not a bad idea to get going right before this bull market next year or the year after, but I'm believing it's next year when the rates start coming down. So looking at the wheel option, there's 2 legs of a wheel option. So hopping in this trader, if you just go in the trade options and then you go into the builder in here and you go up here, scroll up, and this is a single legged, okay? So the 2 legs that we are going to be using is the covered call and the cash secured put. So the covered call is you have 100 shares that you own and you want to sell them for a specific price. So we'll click on this. Say you own 100 shares of Palantir, like I do. You pick an expiration date, which say December 8th. And if you do December 8th, you get all these prices. So I could say I want to sell this at $21 at 6, and I'll get $67 currently. It says 67 cents, but each contract is for 100 shares, so it's $67. You will get right away, and then you will have that on your account, and it will be a liability until the contract clears. So pretty much how this works, I have one for $23 on December 8th. So if the price is at $23 or above, they will execute this contract and they will take my shares and they will give me $2,300. And this price is locked in. It doesn't matter if the shares are 24, 25. It's because I signed and said I would sell my shares at $23. My 100 shares are locked in this contract. I got $29 originally. If I did it right now, it'd be $24. Okay, so this is the first leg. So this is how you do it. I would do it probably 10 to 15 to 20% outside of the money, and also probably a week to 3 weeks out, just to maximize potential premiums and lower the risks. So this is one leg. So the next leg, if you get executed, like I was saying, say it goes up to $2,350, we'll get that $2,300, and then we could hop in on this side, and then we go to just say December 22nd. We could hop in on this side, and we could hop back in at that $23, and we currently would get $333 to do this, to buy at that price, just because the price is so much below that. But if the price is above that, then the price wouldn't be as much. As you can see, $20 would be $130 currently. So just that's right under it. $19.50 for 100. So you could put your capital back into it. And what this side does is this side is saying that you are willing to buy 100 shares at $22 on this date. So you are hoping that it is either right at that price or just right at that price would be the best if you want the shares. If you don't want the shares, then down here under the money would not be bad for you, because then you get to keep the premium and get to keep the cash, and you get a little bit of return, and you can just go out and do another one 20, 30 days out again and just keep doing that. Or you can just straight up buy the shares and then do the other leg of the wheel strategy. But you can do this with anything that you own 100 shares. You can do the covered call strategy. And then if you do happen to sell it, just do the cash secured put, and you get to pick the price that you get to buy your shares back. and it's overall just a great way to get some capital appreciation on some shares that you have a little bit higher volatility and that you're not too scared of parting ways with. Maybe half your shares. Say you have 200 shares. I do contracts with 100 of my shares of Palantir just because I have 200 shares, and it does have a little bit higher volatility, so I can capture some of this higher premiums, and I can just buy them back if the price does go back down a couple percent, and I will get 20-30%, and I'll just buy them back, or I'll hold them till expiration, and I'll just get to keep the whole premium if they're out of the money. So if you guys have any questions, make sure to ask down in the description. I'm pretty knowledgeable on this strategy. There's quite a bit of it's a pretty simple strategy. You just got to be careful. You got to make sure you're above your average cost when you're doing this, because you don't want to be writing them under your average cost, because then if you do get executed, you will be put underwater and just have to sell, so that would not be good. But hopefully it won't happen. I'm well above water with my Palantir shares, and those are the best types of shares to do it with. I have some with SoFi, but I haven't been doing it as recently because those shares have been down quite a bit lower, so I haven't been able to write as many contracts. But like Fubo is another one that I was able to do a $3 contract just because it's been spiking up a good bit. So I think maybe if it pulls back, if say it pulls back to 250, then I will be able to buy that thing back for like $1 or $2. So that's a big capital appreciation just on that $11. And so it's just a little bit kind of like a artificial dividend, you could call it. All right, guys, thank you so much. Thank you for watching, and have a great day. Make sure to subscribe, make sure to like, and make sure to sign up for Robinhood and get those free shares and get investing. Have a good day.